Stock Investing for Beginners. 30 Valuable Stock Investing Lessons for Beginners. Investing, Stock Investing, Passive Income, Stock Market, Trading Book 2. Written by Alvin Williams. Narrated by Joseph M.Clarke. About the author. My name is Alvin Williams, and I am a professional trader and investor. I have always wanted to understand the language of money and to grasp the tactics that rich people use to accumulate wealth. At first, I thought they were just lucky. However, after reading Rich Dad, Poor Dad by Robert Kiyosaki, I was forced to change my mind. There is a reason why the rich keep getting richer and poor people tend to stay broke for their entire life. I dedicated my life to finding this reason and to share it with others. After attending seminars all over the world, a friend of mine asked, "Alvin, why don't you write a book about it? I really think other people could benefit from what you know." At first, I was a bit skeptical. Why should others seek advice from me when there are hundreds of other gurus around? However, after reasoning on it for a while, I came to the conclusion that I had something different. I actually did invest myself. You see, it is so easy to find books and videos by authors that claim to have made millions of dollars, as if it was the simplest thing in the world. I do not even try to claim to have earned so much money. Do not get me wrong. I have made several $100,000 in my life, but I have yet to come close to the 2-comma club. Why am I saying this to you? Because I believe in honesty and building trust. After all, I have started writing this book as a hobby, and I do not need my customers' money to survive. This is what gave me the confidence to stand up and speak my truth. I hope you appreciate it. Enough of me now. It's time to get down to business and start learning. Chapter 1. Compound Interest. What is it and how to use it? What is compound interest? Not everyone may know how to respond immediately to this question. In fact, if everyone knows what the simple interest is, i.e., the one that withdraws at the end of the agreed time unit, fewer are those who know what the compound interest is, how it works, and most importantly, how to take advantage of it. The example of a bank account is enlightening. If on January 1st, I have a net rate of 1% on my account, and the balance is $100, at the end of the year I have $101. The dollar is added to the capital, and if conditions do not change, at the end of the second year, I will not have $102, but $102.01, where the cent represents 1% of the dollar accumulated after the first year. So far, everything should be clear, but most of us cannot calculate the compound interest of an investment and tend to treat it as simple interest. This is due to its slow start, that, especially with small capital, tend to be treated as irrelevant. However, there is nothing more wrong than an investor can do. If, for example, after 5 years of investment, my capital of $100 is now $140, we are led to believe that the interest was 8% per year. This is incorrect, because in doing so, we do not take into account that at the end of each period, the interest accumulated has gone to increase capital. If the interest had really been 8%, composing the 5 years, we would have had initial capital of $100, first year $108, second year $116.64, third year $125.97, fourth year $136.04, fifth year $146.93. The difference, $6.93, represents almost 7% of the total. As you can see, it is easy to take dazzle, or worse, even suffer, if for some reason we are offered a simple interest for a compound interest. The maths behind compound interest, an easy example. Suppose we have an initial capital of $1,000. The capital yields a
Sample complete. Ready to continue?